Hello everyone, I hope you're all having a fantastic day so far. Today, I really started thinking about this question. Do investors control the world? Why do I say this? Well, the given sort of like recent tariff situation that's been happening, that's been imposed by the Trump administration, has caused turmoil in terms of the markets and how we view prospects moving forward when it comes to our economies, business, etc., etc. So, for those of you who've been living under a rock, Donald Trump has imposed tariffs across multiple different countries in order to gain back some income to raise funds for the US and again create homegrown talent. Now, of course, it's not as simple as that because if you're imposing tariffs onto other countries, those countries are likely going to do sort of like ping pong tariffs as well. And we're seeing this with China. You know, it's gone from 50% to 80 odd percent to 125%, 145%. I think I saw 245%, but I don't even know if that's true. But it really means that those individuals who are getting goods from external countries that have those tariffs imposed are actually having tariffs imposed on those who are creating businesses, you know, within that specific country. So, for example, 145% tariff is a tax on those businesses within the US who get their goods from China, as an example. Now, of course, Donald Trump has seen all of this stuff happen where, you know, you have the stocks market, which has crashed heavily, mainly the S&P 500 and other sort of like stock companies as well. So just to be clear, S&P 500 is an index fund, so it's slightly different as a tracker against the top 500 companies in the world, or in the US, should I say. And then you've got the NAS 100 or the NASDAQ, which is the top 100 tech companies in the US, I believe. And then you have other ones as well. But of course, the stock market is more specific to a business entity, so to speak. Okay, so it's rather than a collective of different companies, it's based on a business entity. And so there was a loss of confidence. You know, investors pulled their money out of the stock markets. And so what ended up happening was you saw skyrocketing, okay, down, not upwards, but down. So you had essentially, I think there was a bear market, as they say, so dropping to, close to 20%, and then or 10%. Anyway, you can check out these sort of like statistics yourself. But essentially, there's a 10%, 20%, and 30%. Of course, if it keeps on going down in that trajectory, then it's not looking good. And of course, if you have two consecutive quarters of a 30%, then it's looking like a recession. So we may even be in a well, not right now, but at some point you may be in a recession. You may not even necessarily realize it. So again, I need to check those figures just to make sure that I've got that correct. But I've said it in previous videos, so you can check that for yourself. But it's not about the numbers, it's more about the principles behind it. I really want you to understand this. And so typically what happens is that you have situations where, you know, these investors, okay, may pull their money out of the stocks and shares or index fund market or whatever it may be that they're doing, and they may typically go to something known as a safe haven. Okay, a safe haven is an asset class that is likely going to still produce you the dividends or the yields that you're looking for. And that typically looks like bonds, okay, or treasury bonds, or UK gilts, they're kind of the same thing, or gold. Okay, in this instance, gold has continued to skyrocket. Yes, it's had some dips, but it continues to go up because there are many different sort of like economic factors affecting gold in terms of its buying power. But when it comes to the bond market, it didn't necessarily go up in terms of like people buying bonds. If anything, people were selling their bonds. And why is that the case? There are multiple different theories for this, but essentially this was indicated through yields. Okay, so they're known as US 10-year yields or US 30-year yields. And so if the yields go up, the bonds typically go down. Okay, so this is really showing that bonds are being sold off. So why were they being sold? Well, potentially it may have been a situation where some of these investors didn't necessarily have the capital, okay, to actually put some money into into the bond market. Potentially because, you know, some of these not quite organizations but investors, so to speak, use leverage. They leverage money from the banks in order to use more capital to do their investing, so to speak. But maybe potentially, you know, because of the whole tariff situation, their money was broken to a point of, you know, no return, where the bond market could have been broken completely. And if the bond market is broken completely, it means that governments can't necessarily get money. Okay, because how does it work? A bond is typically a contract, is typically an IOU, and essentially governments issue bonds to investors. Okay, these are hedge funds, insurance companies, pension companies. They buy these IOUs, or these bonds or gilts. Gilts are the UK version of bonds, and essentially the government gets some money for that. And then based on that, there is a certain interest rate that they need to sort of like commit to in terms of payment every single year for the length of that specific contract or that bond. So typically you get 10-year bond deals or 30-year bond deals or whatever it may be. And so if these different investors are selling off their bonds, then essentially what's happening is that they're basically saying, we don't have anything to do this. We don't even have confidence that you're going to be able to pay us back the money. And so what ends up happening is that if these bonds are being sold off, yields go up, which means interest rates go up, which means it becomes more expensive for governments to borrow money for any other investors who are still interested or holding certain bonds, so to speak. So it becomes more pricier. And so obviously that doesn't work for, anyone globally, especially Trump, who imposed this stuff. So what ends up happening is that you have a 90-day pause. If we think about sort of like the situation that happened when Liz Truss was in power, where she was trying to make the UK much more entrepreneurial and create these opportunities or whatever it may be. I don't even remember the policy, so to speak, but I'll probably have to go back to that. The bond market kind of controlled things. You saw crazy changes in that market. And so why do I say all of this stuff? The bond market is the pulse, it is the beat, it is essentially determining the consequences of what happened with the government. And so they really pull the strings. And so you have these bond vigilantes, okay, which are essentially investors who potentially pull the strings based on what they want to happen in terms of a government, an economy, a socio-economic class, or whatever it may be. And so there's a lot to bear in mind here. So if you think about it carefully, without the bond market, you have nothing. And so what may end up happening is that, okay, cool, bonds are being sold off. Donald Trump has paused things. This is where you saw a huge spike in buyers when it came to the S&P 500 or some of these other sort of like investment vehicles, so to speak. But of course, that isn't the full story. This is a 90-day hike. You also saw a situation where essentially Donald Trump it still imposed those tariffs on China, but excluded a lot of tech stuff. So it came to microchips, transistors, mobile devices, laptops, all of that kind of stuff there, all of the techie stuff, because again, we rely on China for a lot of that stuff. I say we, but it's really the globe, so to speak, because obviously it comes through China, then the US do what they do with it, and then they sell it off to the rest of the world. And so there is a lot to say for some of those changes, because he didn't want to piss off the bond vigilantes too deeply, should we say, or the investors who invest in bonds in droves. And so what may end up happening is that, okay, this may affect what happens with the decisions made by the central banks, okay, whether there's the Fed. So the Fed may potentially intervene, and I don't think they did intervene. I think they kept the interest rates at where they're at. And so they're looking at this with caution, and I'm sure other sort of like central banks are doing the same thing. But what may end up happening if this gets worse is that the central banks may get involved, and then printing of money could happen, etc., etc. More money in the system. This affects the interest rates and inflation and all that kind of stuff there. It may lower initially with the aim of it, well, not even the aim, with the eventual sort of like situation where inflation increases. Inflation is just another fancy word for saying prices for goods and services increase. CPI, Consumer Price Index, it increases at a faster rate. That's essentially what inflation is. The interest rates are just a way to control that, just like taxes are a way to control this. Because typically what you have in any sort of economy is you have the debt, okay, so for the UK it's roughly 1.26 trillion. Then you have sorry, it's not even 1.26 trillion, it's roughly 2.3 trillion, I want to say. And then you have the amount of money we can spend, which is 1.26 trillion within the UK. And then you have the total value of assets, which I don't have a number for, but the total value of assets is different, and it's typically much bigger than the amount of money that we can spend, and it's inconsequential in relation to the amount of debt that we have. And so typically you can keep on printing money to a degree, provided that you have the right measures in place. And this is why the bond market determines what happens in the government, because they want to see governments that have good fiscal rules, okay, or good financial sort of like sentiment, so to speak, and are sort of like disciplined and give them some sort of confidence in terms of their investments. So that's essentially what it is. But before I continue, again, if you like stuff like this or stuff centered around portfolio careers, contracting, and consulting, then make sure to subscribe to my newsletter where I talk about this stuff regularly with information in your inbox every Sunday at 2 p.m. But let's get back into it. So the point I was trying to make is, again, they are looking for governments that are very sort of like predictable in terms of their returns, because if you think about why they would typically go from the stock market that may be dipping into the bond market or gold, is because there is a reliability factor. Governments typically pay back their returns regularly. Okay, they don't really default on payments. You don't really see that, and so there is confidence within that space. And so they really determine a number of things. Money that flows into the system, into an economy, essentially whether there is a certain level of inflation or not, if a certain like political party is able to enforce radical measures or not, whether the world economy gets what they get. And so if you have a number of investors doing this, or really a small select group, whether they are bond vigilantes or not, they get to determine the say. And of course, if these investors are also investing in media and housing and land and all of this kind of stuff there, then there's a bit of a puppeteer effect, especially if those investors have a certain sort of like acumen towards a certain ideology or whatever it may be. So anyway, that's all conspiratorial, so to speak. But the point being made is investors run the show, okay? And we saw this specifically with the whole Liz Truss situation. So really and truly, what can we expect to see? Well, the way I see it is, if you want to understand what's happening, really understand what's happening within the treasury yield situation. Okay, so when yields go up, bonds go down. When bonds go up, yields go down. Okay, and so really and truly, watch that situation, because that determines what's really happening in terms of how let's say Donald Trump turns on the tap when it comes to his policy enforcements and everything else. You can check this stuff and stuff like TradingView, or you can type it in on Google and it will give you an idea, give you a sort of graph that you can check out for yourself. That's the first thing. Also check the index fund sort of market. Okay, so S&P 500, the FTSE, emerging markets, all of this kind of stuff there, and see how it responds to announcement, because news really does affect some of these dips. And of course, you could argue, especially because there are tools out there like, I can't even remember off the top of my head, but there are tools out there that give you alerts ahead of time of news that is coming. So you could argue, okay, is this stuff pre-scripted? Is it meant to do this? Is it just a reaction from the market, etc., etc.? So that's the second thing, sorry. Look for how news affects the market. And the third thing is to see how these central banks respond to these tariff moves and respond to the bond market. When you understand that stuff, you can understand what's happening within the economy. Even still, whether it's for understanding of the economy or not, it's a great opportunity to understand when to invest, when not to invest, etc., etc. I'm not the right person to speak to about this specifically, but there are other people you can check out in relation to this stuff who are more versed within that space. But also in relation to this, it gives you an idea in terms of what opportunities are out there when it comes to specific sort of like labor market sort of like opportunities, etc., etc. So those things still stand, but you can see if those things are affected based on what's happening. And so if you can see things are less affected relative to some of these changes that are happening, then there are opportunities within there. So for example, tech is being affected right now. It's a thing. Yes, there's high risk, high reward. But what isn't really being affected? I was going to say water, gas to a degree, oil's being affected. Okay, what other things? Security, not necessarily. Yes, there's an effect, but is it as heavy? It depends what you're looking at, of course. And so that gives you an idea of what organizations, companies, sectors are stable. This is why it's important to understand at least soft socioeconomics of the globe, the global community, or within the UK or US or wherever it is that you're watching this stuff. So hopefully that's giving you some ideas. But yeah, watch the investors. I'd love to know who these investors are who are really sort of like mass changing the market, so to speak. But maybe you know the answers and I don't. So if you do, leave your comments in the comments below. If you want to see more videos centered around portfolio careers, contracting, consulting, and all things centered around soft economics, so to speak, then don't forget to subscribe and hit the notification bell. And as always, my friends, understand, reach, and expand. Peace.